Hello, Christopher Fliss coming to you today from Memphis, Tennessee, founder of Resilient Asset Management. Today we're talking about using capital gains to pay for college. First, a couple backgrounds. When talking about paying for college, the way that we do college funding at Resilient Asset Management for our clients is it's part of an overall financial plan. Trying to figure out the best way to pay for college in the absence of addressing other needs within your financial plan, in my view, is suboptimal. And before you can talk about how you're going to fund college, potentially for your children, you have to look at your overall financial plan. So we use a term we call being brilliant on the basics. Is we have 5 basic areas of which that touch all of our clients. Number 1, we always start with estate. So if you're asking me, should I pay for college? Should I take a loan? Should I do whatever? And I ask you, well, do you have a will? And you say no. Well, we're going to talk about the will first. That's paramount because you have to have a good baseline of a financial plan, a good foundation before you can talk about, well, how are we going to do these ancillary things like paying for college? So we start with the state. We always touch on tax. Look at risk management. We don't sell any insurance products at Resilient Asset Management, but we do certainly evaluate people's insurance posture all the time. And then we look at cash flow, and then of course investments. And we'll talk about investments later, how they can flow into a funding college. But the point is that before we can talk about the college part, we got to get the basic stuff right first. Because if you have this triaging finances, if you will, if you don't have like a power of attorney, for example. But you're trying to negotiate or navigate having to pay for college, the one has to come before the other, at least in the way that we do financial planning for our clients. Okay, now let's talk about the college expense breakdown. First, a word about sticker price. So frequently sticker prices for college just have gotten very high. They've gotten so high to the point that when someone tells you a number, no number is really surprising anymore. Back when I was way back in the day, college was a couple $1,000s. Now you tell somebody you're paying $50, doesn't really shrug a shoulder. I haven't commonly heard 6 figures for 1 year yet, but that's coming sooner or later. But even if somebody were to say that, it's really kind of a shrug of the shoulders. It's not really an eye-watering, nosebleed kind of number anymore. That's just kind of the way it is. But remember, sticker price, there's a certain segment of the college attending population, I think it's about 20 to 25%, who are price insensitive. So they want to go to the best of the school that their child wants to go to, regardless of whatever the price is. The price is $65,000. Just tell me who to stroke the check to, and that's where my child is going to go to school. The competition for those students is very fierce. So colleges have to have a high asking price because there is a population who's willing to pay it. Okay, but like here in Memphis locally, I think probably one of the more expensive schools is Rhodes College. I'm not personal friends with them, but I have spoken to someone who was involved with admissions at Rhodes College, and I think at the time their number was in the 50,000s as advertised for what the cost of attendance was there. But he told me, he said, I can count on one hand the number of people who are paying that fee, because once that population has already decided where to which school they're going to attend, well, now the next college attendees below that, they're more price sensitive. So that's why you have grants, scholarships, all those kind of things that come into play. And unfortunately, there's very little uniformity across colleges in how they do funding. For example, some colleges you'll go through and this is the cost of attendance, it's X, and you can afford to pay Y. That gap, okay, is what they're trying to fill. Well, some colleges fill that with a grant that you don't have to pay back. Other colleges say, well, we're going to meet need with a loan. They say, yeah, we're fulfilling your need, even though it's a $20,000 or $25,000 loan that you're going to have to pay back. So highly dependent on what school that you go to, on how, and none of them are the same. So it's hard to give blanket recommendations in that regard. But as you start to whittle down what colleges are going to be sort of on the menu, then you can zero in on how the different colleges go through meeting the different funding needs. And most people will desire to have some of their college expenses met by other means than just out of their money out of their own pocket. That said, generally speaking, colleges have what's called a cost of attendance, which is subdivided into direct costs. Direct costs are what's paid directly to the school. These are things like tuition, fees, room and board, those types of things. Then there's indirect costs. You have to get to and from school, potentially if it's out of state or a great distance, books and supplies, and then just miscellaneous spending money while the student is attending college. Okay, so that's sort of the breakdown. Okay, and then each school will give you a letter that will break down how those different buckets are filled. Okay, so there will be the part that's going to the direct costs are going to the school. That's the part that they're going to break down in great detail for you. Okay, so from the cost of attendance, you'll see things like scholarships. So there's merit scholarships and there's need-based scholarships. That's money that's simply deducted from the cost of the overall direct cost to the school. It's just a straight deduction dollar for dollar. Other schools will make grants. Grants are kind of the same thing as college, although they could be need-based. The same thing as scholarships, where basically money is just directly given or deducted right from the cost of the direct cost to the school. Okay, then another tranche, if you will, of how college is paid for is through loans. Okay, student loans, very, very broad topic, much in the news. Broadly speaking, you have federal loans and your private loans. Within the federal space, there's subsidized and unsubsidized loans. So in the federal loans, the starts out at $5,500 per year, and it goes up each year of your undergraduate education. Okay, so subsidized means that the federal government will pay the interest on the loan while the student is in school for 4 years. Okay, then after that, then the interest will pick up. So those loans are actually very good because they're basically an interest-free loan for the duration of the college education. But that's also probably going to be the smallest portion of the college bill that's paid for. The other one is unsubsidized federal loans. So same interest rate as the subsidized loan, but interest is accruing while the student is in school. Okay, so the subsidized and unsubsidized portion of the incremental amounts that increase each year, starting with $5,500 at the first year, schools will determine how those things are divvied out. The individual school will, and generally speaking, it's based on need. So if there is a lot of financial need, then you'll be more subsidized. If there's not, then you'll be more in the unsubsidized category. I've seen where it's about 60-40 between the two as well. So it's not an all or nothing. Some may be subsidized, some may not be subsidized. But the subsidized loan, I encourage folks to take those loans because they're interest free essentially. So rather than pay out of pocket today, you can pay the same amount out of pocket 4 years from now. Okay, then in the private market, those are going to be like any kind of, well, not any kind, but they're going to be very similar to signature loans, and it's going to be based on credit, the ability to pay the loan back, and again, no federal subsidy. But the amounts that you can borrow in the private market are going to be significantly higher than what you can borrow in the which you'll get from the federally subsidized loans. Okay, but suffice it to say, there is a loan out there for almost any school that you want to go to, and that's part of the double-edged sword, if you will, of the student loans. You can borrow as much as you want to go to school, but in the private world, sooner or later, that money is going to have to be paid back, and interest is probably going to be accruing all during the time until the loan is actually paid off. Okay, but again, loans are a totally different individual topic that you could spend many slides presenting on. Okay, now as far as ways to pay for college, probably the one with which everyone's most familiar is the 529 plan. The 529 plan is a wonderful, great way to accumulate funds. I recommend starting almost as soon as you can when a child, even before perhaps, saving for the child's education, because broadly speaking, there are exceptions. You just can't save enough for a child's education. The costs are going up, dramatically, and there's really no end in sight to that. And just as an advert, the gains, any kind of money, that growth that happens within the 529 wrapper or account, if you will, is tax free so long as the funds are used for college. And some new Secure 2.0 Act stuff was passed where money could potentially go into a Roth IRA after the fact, not in the scope of today's conversation, but if there's extra 529 plan funds remaining after education is complete, there's a plethora of options: legacy, Roth IRA, taking the money out. You could do numerous things. It's a very, very flexible mechanism, tool to use for paying for college. Okay, there's other options. So one sort of partial drawback to 529s is the funds are kind of restricted. So as you start to accumulate funds, yes, you are getting great tax benefits, but as you get time to use the funds for college, well, college funding may come from different places. Maybe your child is high achieving and they get a 100% merit scholarship to the university of whatever, or they decide they want to go to a service academy, or for whatever reason the funds are not needed. Well, one way to sort of hedge against that potentiality, especially, is if you're paying for primary education, meaning grades 1 through 12. The rule for 529s is that you can use $10,000 per year to pay for primary education. So say, just a very rudimentary example, say primary education costs $10,000 per year, and you have $40,000 going into the 9th grade year of private education. Well, you could use the 529 money for paying for the primary education and take that $10,000 you would have spent on tuition and put that into a savings account. Now, when the child graduates from high school, if you don't need the funds, it's not locked up inside the 529 with restrictions. You have these funds outside that you can pay separately, and by the time you get to the 9th grade year, the risk curve of the 529 is probably going to start to level off quite dramatically, where you're not going to be missing out on a whole lot of growth. So that strategy is not for everybody, but it's a tool, a tool or a strategy to where you can take money out of the 529 and sort of hedge against not needing the funds in there. But again, everybody's situation is going to be unique. Okay, now the thrust of today's presentation is on using capital gains. Okay, so over if you've been saving during all your child's life, you might have some savings in a taxable account that has accrued and garnered significant growth. Okay, so meaning that you have a basis that you paid for, and now there's been a gain on top of that, and it creates a tax burden if you were to liquidate that for yourself. Okay, so here's just a basic example of what I just illustrated with words. So you have $20,000 of XYZ stock. Of that $20,000, $10,000 is basis, $10,000 is gain. If you were to sell that $20,000 investment that you've owned for longer than a year, then the highest capital gains tax rate you would pay, regardless of your income, is 23.8% at current rates. So that $10,000 gain would be reduced to $76.20 because you would pay the $23.80 in capital gains tax to the federal government, where you're ignoring state income taxes in this example. So you would only net out $17,620 out of the $20,000 investment if you were to use this investment to pay for college. Okay, so let's freeze frame that for a second and talk about some dependency stuff. So since a child is born and parents file their tax returns, the child, for most people, is claimed as a dependent. Okay, that dependency is actually a very strict test that the IRS gives or thrusts on people. Sometimes you'll hear about people who are taking care of parents or elders, and they want to claim them on their tax return, and they do that because they're paying for a certain amount of their expenses throughout the year. Well, the IRS has a tool, you can Google it, IRS dependency test. And the first question, well, one of the first questions is, do you provide your own support, yes or no? Okay, well, support is a very it's described in great detail in the IRS publication. This is a subset of it. But support includes amounts that include the following: food, lodging, clothing, education, medical, dental care, recreation, those kind of things. Okay, so if your child were to pay for their own education, for example, then potentially they would not qualify as a dependent on your tax return. And under the current law, once a child turns 17, the maximum tax benefit is a $500 tax credit on the tax return. This ignores all of the things that happened during COVID, where there were some special rules in place. But now that those programs have ended, it's a $500 tax credit on your tax return per child. Okay, well, that could pale in comparison on the capital gains example I'm going to illustrate here in a minute. So now, when you're dealing with capital gains tax rates, okay, the tax code, based on your income, earned income, you have the 10% bracket, the 12% bracket, and so on and so forth. Well, for capital gains, there's only 3 tax brackets: 0, 15, and 20. Okay, so these are the different ways you can file: single, married filed jointly, married filed separately, and head of household. Well, single, most college freshmen who are 18 are single. So what we want to do today is we want to try to leverage this 0% tax rate, because when you're single and your income is below $44,625, your taxable income is, your tax rate is 0. Let me say that again. When your income is below $44,625 and you're single, your tax rate, capital gains tax rate, is 0. Okay, that's important. Okay, so now we go back to income taxes. So there's a great tool at guidestone.org. It's called the 1040 tax estimator. Okay, so if I go in here and we satisfy, so the strategy here is, when your child goes to college, not necessarily turns 18, but when they go to college, what you can do is you can transfer appreciated assets to your child, okay, as a completed gift. Then those assets are theirs to do with what they choose. Okay, they can then file their own tax return, okay, and file as single. And when they liquidate, in that previous example, let's use the previous example, the $20,000 investment that you were to give to your child, and then they were to then sell that in investment, their capital gain, I've already pre-filled the form here, your child would assume they have no earned income, and they have a long-term capital gain of $10,000. Well, if you look down here at the tax that's due, taxes before credits, the tax would be 0. So rather than paying the 23.8% tax that you would have as the parent on liquidating the asset, you transfer it to your child. They then sell the asset and use for school, and because it's their money, they're now qualifying as being independent, meaning not being a dependent on your tax return, and they can then file their own tax return and avoid that 23.8% tax that you would have had on the same asset. Okay, now, so then it's like, well, now I want to leverage this thing up, tremendously. What can I do? Well, I have the number already pre-programmed where all capital. So let's say you were to transfer something where there was a $58,475 capital gain, not total transfer, just the capital gain part. Okay, so say it was $100,000 and $41,525 of it was basis and $58,475 was gain. Well, using the same logic, the income tax is still 0. Okay, and the reason that is because that $44,625 of taxable income, the capital gains rate is 0. Okay, remember, you get a standard deduction when you file independently. okay, and I can prove that it'll eventually taxes will accrue. If we take that up just $5 more, okay, then you have your first taxes due of $1. Okay, so basically 58,475 and below for 2023, there would be no capital gains taxes on that sale. Okay, so that's a very important way. This is especially important for folks who have been late to saving for whatever reason, but they have appreciated assets, investable assets that they can transfer to their children. Okay, so if you were to employ that strategy, it's a multi-pronged, multifaceted thing where there had to be gifting, accounts would have to be set up for the child, then they would have to sell, the tax return would have to be filed. So there's a lot that kind of goes into that. And again, that's just one aspect of the overall picture of both paying for college and ultimately your finances as you're navigating through the tangled web of college funding. Okay? All right, so we talked about a lot of things today: student loans, college, application funding process, all those things, and primarily capital gains used for college funding. That's part of a much bigger discussion. So if you would like to delve deeper into your personal situation and how some of these strategies might apply to you, then please feel free to reach out to us, and we'd be happy to talk to you about these and both college funding and other aspects of your overall financial posture. Thanks for the time.